Hello, I am Frederick Bell, the CEO of Elemental Altus Royalties Corp, a fast-growing gold and copper royalty company listed on the TSXV.
Good to see you, Fred. Right, it's been a while since we spoke. You've been busy. 2024, not a bad year for you guys, and you're kind of kicking off with a few moves at the board level, some new names. Why?
Yeah, look, it's a long way from when we started as a private $1 million company. And I think as we have evolved, a greater focus on North American capital markets and a greater focus on the royalty space. And so, look, the additions to the board, I think the three additions we've had, all really strong additions. Prashant Francis, who is the principal of Altus Royalties, our new 14% shareholder, he's been involved in the royalty space for the last probably 4 years or so. He's based in the UAE there, and we've looked at opportunities in the past together. The second director is actually the nominee from La Mancha, our largest shareholder, Mathieu Boss, and he is CEO of TSX, a Canadian listed company. And he's actually based here in the UK, but spent a lot of time in North America and used to work for BMO and Ivanhoe, so very familiar with the space. And then the most recent addition, just coming in at PDAC, was Sandeep Singh. He used to be the CEO of the Cisco Gold Royalties, and so again knows the royalty space inside out, and familiar actually with us and the portfolio and the company in the space. So all three of those, I think, give us a better market presence in North America. We're really grateful for the directors we had on the board who helped us get to here. And I think we're really excited about what we can add to it as well in terms of their skill sets, networks, and connections going forwards.
Right, I guess for a couple of them, part of the role is to kind of keep a close eye on what you're doing. But with regards to the part of their function, which is to help you drive growth, what is it precisely that each of those brings to the table for you at this stage of your development?
Look, I think in the case of starting with Prashant, who came on in October with that transaction, clearly they have deal flow that they see across the royalty space as well. And the origin of that relationship was probably the syndication of a portfolio deal going back to, I think it would have been 2021. And so I think that they both have the ability to deploy capital themselves, the ability to co-invest, and the ability to seal deal flow. So from that side, I think it's really helpful. And their team has some technical members on the team who we can also look at opportunities with. So from that side, it's been very good. And then Sandeep, just the most recent addition to the board, I think Sandeep has been spent a number of years looking at royalty opportunities in the space, and I think sometimes the challenge is not just finding the opportunities, but also being able to recognize the good ones and focus your limited time and energy on that. And
believe me, we'll spend some time on that one in this conversation, because I think that's so important. I'm going to sort of jump straight in with the kind of the 2025 outlook. Okay, you basically made some statements about the ability to maybe look at a 50% uptick in revenue this year. Can you kind of maybe detail some of the assumptions underlying that?
Yeah, look, I think we've guided for $30 to $34 million US of revenue. And that is at $2,600 gold price, and I believe it's at a $420 copper price. And so, look where we are today. We also have an estimated $13 million to $15 million US dollars in portfolio payments, and the largest one, about $10 million, we're expecting in April to receive, and approximately $10 million US. And so, where we are as a overall, that positions us in the realm of the lower end total revenue. You're talking about sort of 43 to 40, I think $48 million of revenue this year, US dollars, versus last year. And our announced numbers for last year were 21.6 million. So we're going from 21.6 million to midpoint about 45 million US of revenue. And if you look at our G&A, I think our G&A is going to be pretty much exactly the same. Call it 6 million roughly. US, and we're probably going to pay $4.5 million in tax, and that varies depending on the royalties, obviously. But what you have then is a company that has a relatively fixed cost base of, call it 10 million all in on this portfolio. And so if you're going from 21 million revenue to 45 million revenue, everything above that is the margin.
Right. Okay. So maybe it's worth spending time about trying to understand how you value the company, because I think what's clear is maybe the market is not understanding how to value you in terms of the share price is kind of trending sideways for the last four or 5 years as you go through this kind of growth phase. But now you're at this kind of step change, a moment where you can maybe start to differentiate yourself from some of the peers that you get mentioned in the same breath as, but more importantly, kind of return on that capital invested. So talk about some of the metrics that you look at and maybe give us a clue as to what you think is important for us to look at as investors.
So I would say historically, price to revenue, we have probably traded about 10 times price to revenue. And coming into 2025, and I think the equities have lagged gold, especially the junior equities, but coming into 2025, where as it is trading today at probably about 6.5 times revenue, using the $2,600 gold number for the year. So I think that is a long way off where we have historically traded. I mean, it is around the lowest on a revenue basis that we have been in. And if you look at the junior space, we've got the lowest price to revenue in the junior space. If you look at the mid-tier space, they might be trading around 15 times sort of price to revenue. And if you look at the majors, they're probably trading around 20 times. So on any of those spectrums, we present as a really compelling buy. And in terms of what we have done over the last year, if you'd spoke to us a year ago today, we would have had $30 million in debt drawn on our credit facility. And as it is today, we have over the last year paid down all $30 million of that debt. So we now have an increased credit facility, but completely undrawn, coinciding with record revenue and a valuation that on a revenue basis is around as compelling as it has been.
Okay, but you're kind of competing against gold producers at the moment, and I guess probably argue near-term gold producers in the market. I mean, how do you comp yourself against those companies, touch companies?
Look, in terms of a gold company, I think we're always viewed fairly differently because we probably have revenue from 10 assets, which is more than most even of the mid-tier large gold mining companies. So we offer a much more diversified portfolio typically than you can get access to. I think one of the real attractions in a royalty company that you get is, as well as that other 60 or 70 exploration and development royalties, which we don't factor in when we talk about revenue, but which we have in the portfolio for free. I think that when you look at it on the actual exposure, we are effectively, to a large extent, protected against inflation in the way that our royalties come off the top line revenue. And so that when you're looking at a producer versus a royalty company, for the royalty company, you're looking at you've got more downside protection. On that front, you don't have the inflation side of it, and you have all the exposure to the upside. On the flip side, you don't always have the leverage that a gold producer can have. And so those two different investments can perform different functions. But I think historically, the royalty space has performed extremely well by offering that diversified and effectively inflation-proofed exposure.
Okay, inflation-proofed and de-risked kind of across the board. I get that. But not even royalty companies are immune to what's going on at the moment. And neither are gold producers, it seems. The reaction in the market to these kind of the sort of tariff wars we're going through, a temporary situation for sure. But what's your message to your shareholders? Because you come off in the last week or so, like.
Yeah, look, I think what's really interesting for us is the spot gold price. It's been around $3,000 gold of recent times. The long-term consensus price, even though it has moved up significantly over the past 3-4 months, this longer-term consensus price is around $2,200 gold. So if you're looking at a portfolio today, on a long-term price, it is being valued around $2,200 gold versus a spot price. Now, if we had a development asset we were looking to put into production, that might not matter so much because you're going to, 3 years, 5 years. But in a portfolio where your predominant exposure is to producing gold assets today, every single day that gold price is above, consensus pricing, we are actually benefiting from it, and our shareholders are betting from it, notwithstanding what is the noise and going on in the market around it. And so, from our perspective, I think it's these current spot prices are incredibly helpful for us. And of course, there's always a quarter or more of delay from our financial results and that feeding through for us. But this year, Q1 is going to be a record. Q2 is going to be a record by a large margin. I think we're forecasting all in about 100% increase in revenue from 2024 to 2025, and so that's going to really start to show up when our Q1s come out in the middle of April. Middle of May.
Right, and that's a reflection of gold price where it sits today and your expectations going forward, and increased production.
Absolutely, and two major factors driving that. The first one is the consolidation of the AlphaStream portfolio that we announced in October of last year, and so this year will be the first year we have a full contribution from that, and I think we would probably be anticipating $7 to $8 million of revenue, additional contribution from that this year. And then we also have the startup of the Corrali Sud royalty with Allied Gold, and that is the first quarter at the end of last year of production. But this January will be this Q1 2025 will be the first quarter we get paid for it. So I think that those two are the large catalysts driving the portfolio revenue growth in 2025.
Right. Okay. And again, I promise we'll come on to those as well. And just in sort of sticking with the kind of revenue structure and forecast, and showing the kind of resilience. There's the de-risk component, and there's the kind of resilience, because obviously, I think we've seen a few companies kind of fall over, not just delays, but operational disruptions kind of across the board. Are those kind of factored into your expectations for 2025?
So yeah, it's a good question. We've tried to give a broad a range this year of 30 to 34 million in terms of the guidance range. So we have actually taken, for some of our operators, their guidance range, and we have widened it further to make sure that we think we're putting something out that we're going to hit. And part of the reason for that, as you know, is that a royalty company, you don't operate the assets, so you're very dependent on the operators. So I think for this year, we've done a slightly wider range to try and ensure that we can capture, upsides and downsides, quarterly swings, timing swings from asset to asset. But the broad picture that we have seen consistently now over 7 years of the company's history has been record revenue growth every year, and typically that has been weighted towards the second half of the year as we have been growing, and it's increasing sort of every 6 months. Unusually, this year, the first half of the year, actually, a lot of our revenue growth is weighted towards H1. So I think you're going to see some over the next 3 months. There's going to be some really material revenue growth feeding into the company, and in a position where, for the first time in 4 years, we actually don't have any debt on the balance sheet, and we're in the strongest financial position the company has certainly ever been in.
Right, and how important is it with this kind of, I guess, to benchmark yourself against what, say, third-party analysts are saying, because they're incentivized a different way, versus what the company is saying, because they need to kind of push the best version of the story out there. I'm so interested in kind of the mindset of the team. When you're starting off, you need to kind of everything's got to be good news. When you're sort of producing revenues like you are, and you're looking at the step change now, what's important to you in terms of how people perceive management's reporting and guidance?
It's an interesting question, because it's actually one that we have discussed ourselves internally. And last year, we put in place quarterly sort of run-throughs of the financial results, which we haven't done historically. And effectively, it was we did a cash flow waterfall, and we went through how the accounts, sometimes with royalty companies, and any company really, you receive the revenue, you have to account for it in a certain way, and sometimes it's actually helpful to sort of retranslate those financial statements back into the real world. And so we last year started doing these quarterly calls after the financials, because I think it actually tells a really good story and an important story, and it also enables us to sort of cut through in a more direct and easier to understand way some of the financial numbers. And I think that's as we go by, I think small things like that, but always incremental improvements, trying to improve the communication, trying to make sure that we are getting across the story and showing the progression quarter to quarter. And so that's something that we'll continue to do quarterly.
Right. And how's that reflected in terms of the change to the kind of share register? Because you go through the phases, you're attractive, $300 million company now, the revenue profile's interesting now. Have you seen that kind of market movement towards sort of better quality institutional or even family office type investors?
Look, we've always been, I would say for a long time now, we've been unusual in that the quality of our shareholder base has probably been more akin to a mid-tier minor, $2 billion mid-tier minor than it has been a 200 million US market cap company. So we do have a lot of institutions on the register. We've had at least one recently come on for the first time that we know. So I think broadening that shareholder base has always been in something that we've been looking to do. And certainly if you look across all of our peers, I think we're probably the only one in our sort of peer group that doesn't have a US listing or one of the few. So I think there's a few things we'll continue to do in terms of making sure that we improve the quality of our communications, presentations, but also financial results in terms of getting coverage and in terms of stepping up maybe to a potentially US listing and giving a wider breadth of investors there. But all of that is really the secondary part, which is building on the deals and the portfolio and the value you can add. And I think that is when you talk about what has changed as the company's matured and grown up. Lots has changed, but that mentality of the sort of founders mentality, and we've got to go out there and eat what we kill. And we've really got to make those good quality transactions that we can build the company on. I think that remains the mentality, and it has to remain the mentality for us to stay competitive and focused.
Right. Okay. Yeah, it's an interesting moment for you for sure. Just let's take a look at maybe I know you mentioned it briefly, and certainly in terms of the debt reference, in terms of the kind of target capital structure for now, and how that evolves going forward in terms of getting that balance between the equity, debt, and cash, etc. And you've got the facility there as well. Bigger companies tend to treat debt differently. You want to quickly get rid of it. It suited your purposes for the time being. But how does the company evolve in terms of that management of cash?
So look, it's an active management. The nice thing with the credit facility we have now, and it's National Bank, CIBC, and RBC, so 3 banks on it. But the nice thing about it is that we can use it at short notice, very quickly and flexibly. And so I think we moved last year into a sort of active cash management phase, where if we had over a certain amount of cash on the balance sheet and we didn't have a transaction in the immediate pipeline in front of us, we just used that to pay down the debt because we would have a saving on it, on the interest rate and the margins of what we get on interest from the bank versus what we're paying on the loan. So I think that's how we've managed it to date. I think that in the short term, sort of in the coming weeks, we're probably going to be having sort of $15 million, $20 million of cash on the balance sheet. So then we have sort of different questions, which is, should we put some in long-term deposits? Should we deploy some on deals? We put in place just recently, a few weeks ago, a normal course issuer bid, which was the first time the company's done it. And we haven't actually used it yet. We're in a blackout for accounts, but we have it in place so that we can do it, target it. And then, other questions like the dividend and when a right time to introduce a dividend is for shareholders, something that we had as a private company before we listed, and we haven't done yet as a public company, but it has been on the radar to do going forward.
Okay, so I want to be clear, current market conditions is not how you're making decisions. This is a long-term strategic approach to the kind of management of the capital structure. Okay. Things that will kind of affect and drive that in terms of any reference, maybe some of the new guys to join the team can help you with looking at the kind of credit facility available to you. Clearly, if something comes up, you'll want to, and it fits the bill, that you want to go for it. So what does that look like now? When you're evaluating new royalty acquisition propositions, what are you looking for today?
Well, I would say that I think almost every year, probably without exception, we have transacted on cash flowing royalties. So I think that still is a high priority for the right opportunity where we can add more revenue, because at the stage we're at now, we're mature enough that if we added $10 million of royalty revenue tomorrow, we wouldn't be adding anyone to the team. So you would have that revenue growth, that margin expansion that you could put in. Today, where we have it, we have 50 million undrawn on the credit facility, and we'll be building up cash pretty quickly over the course of this year. So there's clearly a much larger capacity and ability to do transactions without doing equity raises than there has ever been in the past. And I think in terms of our go forward plan, it's to continue to look at good quality producing assets. The primary focus on precious metals, gold, but we have done copper and we have done some other commodities alongside. But we also, in the last 2 years, have started to layer in development assets. And those are things where we can see deep value, but we also recognize it might take 3 years, 2 years, 3 years, 4 years, 5 years for some of that value to daylight. But we think that starting to layer in those types of opportunities are going to be really accretive for our shareholders over the medium term.
But what are those kind of metrics? Like if I take, for instance, like the recent AlphaStream deal, when you look at the kind of payback periods for something like that, or rates of return, or how do you like to measure these things? Looking at now and going forward, what does that kind of blended approach look like? You give us some clues there, but what do you think is the best thing to kind of help you with the growth profile that you're going to want, so people can actually also judge you on, driving that share price, which you're going to want to do, and maybe making yourself attractive at some point for someone else to come along and take you guys out. Your favorite topic, I'm sure.
Yeah, never far from the questions we get asked.
Still hurts.
But yeah, look, it's in terms of what we did, and maybe I'll use the last 18 months as an example. We bought a portfolio from AlphaStream that was it was approximately, I think, 20. It was over 24 royalties, and 3 of those were producing assets. And so, at today's prices, it's sort of maybe 7-8 million a year of revenue that we added in. But we also got an additional 21 royalties that were in the exploration development phase across that portfolio. And the other transactions that we've done in that time frame, we bought a royalty on the Mactung project with Fireweed Metals, and that was a project where they've subsequently been given a government grant by the US and Canadian governments to fast track it to a final investment decision by 2028. But look, that's a project that had 7 years of permitting on it historically. I think it's a really good, high quality tungsten project in terms of the global portfolio of tungsten projects, and with a company and backers and government support that can actually move it ahead. And so that is something that if you're taking it to final investment decision in 2028, realistically, there's a time frame there to production from that construction commissioning that is further out. From where we are today, you're looking sort of 5-year time frame. But when we look at it, we see the potential to have that royalty, which we paid $3.5 million for up front. We see the potential for that royalty to be paying us, the acquisition cost on an annual basis going forwards. So clearly they're going to come out with a mine plan, but that is a sort of deep value opportunity that is going to take time. And if we can do those types of deals, and another one was a royalty we bought on Arizona and Sonoran's Cactus project, and we bought that in, it was actually not 2024, it was 2023. But I think, just recently, Royal Gold, one of the royalty majors, acquired the sister royalty to it, and they paid approximately 65% higher price. And I think the market reaction was that was a good transaction. So clearly you can buy some of these royalties that are in that time frame, and you can get, in our view, attractive prices when you do it sensibly. But it's also important to marry that with some cash flow and revenue growth, because you continue to get that margin expansion. And at the size we are at, it is so meaningful every $5 million that you add in terms of revenue, because of the margins and because of the the scalable nature of the business. So I think we continue to do the blended approach, and that will probably vary up and down with market conditions and with where we are and our portfolio is. But broadly speaking, we're definitely looking at both producing and non-producing assets.
Right. And if I look at something like AlphaStream, you mentioned sort of obviously revenue flowing, nice, but 21 exploration and development stories. Do you think that the market is valuing, in fact, are you valuing exploration royalties differently now compared to, say, 2020, when I know you were just starting off in the public markets back then, but the market seemed a bit crazier then. People were paying a lot of money. Do you think you're getting better value now? Are they worth less now? How do you approach the financial valuation component of exploration and development?
Look, it's an interesting one, because if you look at some of those projects, we've bought a few exploration and development ones over the years, and they've been relatively quiet on the outside. But actually, there's a couple of them, I think, at the moment that are having some material step changes in progress. Often, when it's in that stage of advanced exploration development, it can feel like it stands still for 18 months, and all of a sudden, there is a feasibility study, there is a catalyst, there is an acquisition, and it changes. And overnight, that royalty has suddenly got a timeline to production, and the right owner motivated or financially capable of building and advancing the asset. So I think the way we try and focus on it is we try and focus on it from a geological perspective first. And is this an asset fundamentally that stands up to scrutiny and is likely to get built? Does it have exploration upside? And our view is, if that is the case, even if for exploration development assets, even if it's not necessarily in the owner who could build it today, I think that down the line, more than likely, it will, one way or another, find its way into the hands of someone who is going to take that project forward. And there are plenty of projects we're looking at, or you can see in the market today in 2025, that 3 years ago people said that will never get advanced. And maybe those are sort of 1 gram lower grade projects that 6 years ago, when they were trying to advance it, people were skeptical of. And 3 years ago, someone said, I think this is going to work. And you look at it today and it's an operating mine. And I think identifying those sorts of opportunities is important, but you also have to have the capacity and the financial capacity to be able to invest in those maybe before that value has really sort of come to the front. Because by that point, you're not going to get the same, you're going to have to pay a different price for it likely. And so that necessitates taking a longer term view, and it necessitates being patient with it. But it also, it means you do have to think in at least a medium term outlook. And you can't ever put aside the short term, but you also don't want to sacrifice long-term potential. So I think we try and think about it from a geological perspective first. What is a quality asset? What has the potential? Acknowledging that it is the earlier stage you go, the higher the risks are. And if we can have a portfolio approach, then we can balance it across. And if you look at our portfolio today, we range all the way from early stage royalties, joint ventures on early stage JVs with Rio Tinto, early stage exploration in Egypt, which has actually been progressing a lot in the background, and some of our other assets all the way through to brownfields, former gold mines in Canada, in Australia, in that portfolio. So I think we've actually got a pretty good spread on it, but we're going to continue to strengthen it over the coming year.
Right. And do you think, just again, coming back to this mentality of the board, etc., especially with the new guys on board, worked at big companies. Are you looking for large scale transformative acquisitions, or does that kind of sit outside the kind of risk profile of how you built the company to date?
Look, we could definitely, I think if I was looking at the royalty space, junior royalty space from the outside, I think at this stage I would say that you're probably one of the most attractive vehicles. If I owned a royalty personally, to put it into a company, I would probably say Elemental Altus is one of the most attractive, because we've got pretty low fixed G&A base. We're debt free. We've got an awful lot of revenue generating assets. We're well diversified and with a great shareholder base. So for all of those sort of boxes to tick, I think we're definitely we would be the right portfolio to put material assets into. Clearly, it has to fit us. And clearly, if that isn't a transaction that involves an element of equity, versus just cash, that has to make sense as well. But we are looking across the range from smaller transactions all the way up to, adding a third really cornerstone asset for us in the decades to come.
Okay, so a material portfolio you feel could slot in, well, if you guys got on and are kind of suited to the portfolio, that's possible. That's a possible. Okay, let's just talk about the I guess this kind of state of the market at the moment in terms of opportunities out there. In which case, are there big projects still to be had? Are there good deals to be had? Because it's been a very quiet. The royalty space has been kind of quiet across the board. There was a kind of flurry in 2020, 2021, a flurry of wannabes, young pretenders. Hasn't kind of worked out for a lot of them. What's the kind of secret to kind of keeping the kind of growth component to your business?
I think you've got to stay hungry, first of all. You can never sit back. You've always, as soon as you do your first deal, I remember when we did the largest transaction, the size of the company at the time we'd ever done in 2021, $50 million company doing a $50 million transaction. I think on the day we announced it, we got an email from a shareholder saying it's all very well and good, but when are you going to do your next transaction? And we had to explain that it was still a few weeks away from actually closing, and there was a lot of work. So I don't think that pressure ever dissipates. As soon as you do your last transaction, you're on to your next, and there's a saying, you're only ever as good as your last transaction. So it's always a sort of hamster wheel of looking at opportunities. But the nice thing that you do get over time is you build up a really good sort of intellectual property IP database of opportunities. And the more you have looked at, the more you have reviewed, the more likely it is sometimes that we see a project for the second time or for the third time that has advanced its way down the line. And actually, or maybe it's got a different owner, or we're in a different gold price environment, all these sorts of things that mean that I think a lot of the work we do is actually an investment in the medium to longer term in future opportunities. But in terms of what we're looking at the moment, I would say we're looking at everything from $1 million up to sort of $50-60 million transactions. And so we've been continuing to do that. And I think we'll look, we clearly have the capacity to do large, meaningful transactions that move us up a level. But we also never want to get away sometimes from those smaller transactions that actually you might not be paying a lot for it, but sometimes those can be the best opportunities out there. And so, look, we try and remain nimble and flexible. And one of the advantages of being a relatively small royalty company is hopefully you can maintain that sort of fleet-footed entrepreneurial attitude.
Fleet-footed entrepreneurial attitude. Do you think you can maintain the same kind of levels of efficiency? I say in this return on capital. You mentioned that at the outset. It's something that's obviously driving you. With the types of deals you're going to be doing going forward, do you feel that that's possible in the market?
It's a really interesting it's an interesting question, because when you're a private company, you have very low overheads, very limited costs. When you're a public company, there is a certain element of fixed costs you can't escape. And so being a public company brings with it the necessity for a certain size and scale to make sense and to maintain that efficiency. I would say two things where we are at the moment. Use a credit facility as an example. A $20 million credit facility to put in place costs the same as an $80 million credit facility would, or an $800 million credit facility broadly. So actually, when you're looking at these things, that size and scale is actually helpful. And in terms of the team, I think we probably see it most of all in our team, where we actually, I think today where we sit, we have some spare capacity in different areas of the company such that we could comfortably do, whether it was a large portfolio transaction or a large M&A transaction, we could do that and we could continue progressing in parallel moving. And I think putting in some of that latent capacity, it's also, of course, an insurance policy, making sure that we got cover for different roles. But I think that's part of what we have layered in and built as we've grown the company. So as it is today, I'd say we could probably, double the size of the company from where we are now, and we might add one employee or two. But were we to do $100 million royalty transaction tomorrow, we might not actually need to add anyone to the team.
Okay. Well, I'm so conscious of time here. I did want to sort of talk about, well, you have dropped them into conversation, Carl Wyndon, Casarolas and Volley, etc., and obviously Mark Tung, and things like that. Maybe people can go to the asset handbook and kind of get an update. You published at the end of last year. How often do you update that, actually?
So we've actually, there should be 2 behind me in the background, proudly displaying in the bookshelf there, but those were our first one in 2023 and the second one in 2024. So we do it once a year now, but it's a good update on it. We normally find that the moment we publish it, there is a corporate transaction or an asset moves to someone else and it's quickly dated. But I think it's a nice summary tool for investors to look through the other 60 royalties that we have. And I think our portfolio now covers over 13,500 square kilometers. And that's ranging from the producing royalties all the way through to early stage exploration, projects where it's probably option value. But I think that is something we want to build on as well, which is building out that coverage and trying to layer in the optionality across the portfolio. Okay,
well, it's definitely worth a look then, and perhaps maybe even next time you're on, we can kind of go through maybe some of these kind of top performers, which would be good. It's pretty impressive. I was talking to a chap today. The red book for the uranium space came out Monday. It's using data from 2021, so there we go.
Yeah.
I'm sure there's a lot more up to date than that. Okay, well, look, Fred, appreciate the update. Obviously, I think you're setting up 2025 to be rather spectacular. So in terms of revenue, maybe you start getting judged as such. So we'll see you soon, sir.
Much appreciate it. Thanks, Matt. Good to be back on.